Yeah, we were talking about this before. You almost can't keep up with the news flow. I mean, it's an exciting time. We know that gold is up nearly 25% year to date. Bitcoin and equities have pulled back quite a bit here. Now, you've suggested this could be a profound reversion cycle. What exactly is breaking down in the relationship between gold and risk assets? Let's get into it.
Well, it's the most significant thing that's breaking down in the macro of everything is U.S. stock markets going down. As you were doing the intro, I just brought up my latest. So far this year, we've dropped $6 trillion of market cap. To put that in significance, we rallied 12 trillion last year, so we've taken back half of it. But that was the biggest pump in history, as a classic sign of a bit of an extreme, and now we're pulling back, but we have very good reason for doing that. So when I mention that, that's right. I have to mention crude oil's going down, copper's going down, cryptocurrencies are going down, and bond yields should be going down, but they haven't yet. It's just a matter of time. The key thing I'm going to be publishing tomorrow, after we air this segment, is how we've only had a blip in the trend. And the key
Right.
trend that I think really matters, if you take the U.S. stock market divided by the rest of the world. We use the MSCI SUS. You can go back to 1969. It's been in an uptrend since the bottom in 2008. Straight uptrend, clearly ready for a breakdown. And it's only bottom to near that bottom of the uptrend. It's nothing so far. My bias is we're going to break down through that uptrend. We have good reason to do it. What's happening with the U.S. Leadership. And everything is going to trickle that way towards a normal deflationary cycle after the inflation, which means still think gold and long bonds will be some of the best performing assets this year.
Ratio.
Yes. So first of all, I do think Bitcoin has a good chance of going back to 10,000. That's only where it was a few years ago, before the biggest money pump in history in 2020 and 2021. The Bitcoin to gold ratio right now is about 26. Bloomberg Economics, Bloomberg Economics models, and my colleague Josh Daniels have created a model that shows, and it's very good overlaid with Bitcoin to gold. It shows it's probably breaking down below that low around 17 back in Q4 and going to break down. So right now it's around 26. Model says it's going to break down. Indicator shows it's going to continue lower, and it's heading lower. The question is what shifts that? Will the model be wrong? Will something shift to make it go higher? And I don't see that right now. The key problem I have with Bitcoin so far is, yes, it was a good asset to run up. Remember, some of us made a prediction it'd go to 100,000 when it was at 10,000 in 2020. Got that one right. But now I just think it's mean reverting. The bottom line is it is a highly volatile speculative risk asset, and it's already been pumped up to the key, I think, threshold of 100,000. Last year, I think, put in a pretty good peak. The bottom line is it has millions and millions of crypto dependents. In 2009, there was one crypto, that was Bitcoin. Now there's, according to coinmarketcap.com, there's 13 million of them. And all of them are correlated, and all of them are dependents. Things like Ethereum are continuing going down. Dogecoin is a joke. It's still worth $20 billion, which is kind of a joke. And then you look at the precious metals. Gold has three precious metals dependent, silver, platinum, palladium. Now all those are only going up because gold's going up, because the fundamentals for the industrial precious metals are tilting lower, like they are for copper and industrial metals. Is it going to get better with the rest of the world facing U.S. tariffs that have barely even started? So I think this is early days. I think what the volatility we're seeing right now, maybe the market will be more orderly. I mean, the VIX at around 32 right now. Still kind of high, but to me, it's the beginning of a bear market in the U.S. stock market. Most people have not seen, and I think it's going to be akin to 1999 peak and the 2008 peak, and it's just getting started. I'm looking for indications for that not to be the case. Bitcoin, gold's in the space. The key thing that really strikes me is Bitcoin was born of the financial crisis, and it rallied on this massive pump in liquidity in the stock markets. Now it's just starting to tilt down. It looks like it's early days. Some people say it's a dip to buy. I say probably not.
What's the macro signal from gold outperforming both sovereign debt and crypto here?
Gold outperforming crypto is not a big deal. It makes sense. Like I said, Bitcoin and certainly cryptos, the whole space is completely correlated to the NASDAQ and the stock market, and that's heading lower. Bitcoin is more a digital version of gold, but we're proving it's more right now leverage beta and going down. But it's versus U.S. Treasuries. That's been the significant thing. And sometimes it's better for me to remind myself and viewers what I've been pointing out for over a year, that the gold is the most expensive ever versus the U.S. long bond market. Now we go back about 35 years. It just keeps getting more expensive. The thing is, we're having issues in this country, obviously, with too much debt, and the transition to the tariffs creating more inflation that's transitory. And to me, the key thing is we are heading towards a severe deflation, which is very worthy of the inflation. The bottom line is We see deflation in China, the world's second largest economy. Its 10-year note yield at 1.66. I think the U.S. 10-year note right now about 4.4 is going that way. I've been early, but right now we're seeing some deleveraging. We're seeing the transition period. And to me, the key thing is, and I would publish it as we haven't really seen a significant breakdown yet in the U.S. stock market versus the rest of the world. Now we've come back to the trend line, and its trend line's been in line in place for since 2009. So 16 years, we will break that trend line. I think it's going to happen this year. Then you see the serious deflation from the inflation. So I think we're early. I think it's a matter of time. We're seeing significant austerity in this country. People push back on that, but we are cutting back a lot, way overdue. The Fed cannot ease because of what happened last year. They eased too, well, not so much early, but they eased with the stock market on a tear and helped boost it up. Now we have sticky inflation, most notably from the wealth effect, and everything's starting to roll over. The key thing I like to point out is this is a paradigm shift in austerity and tariffs, and it's coming at the time when the stock market was just at about a century high versus the rest of the world and versus GDP in this country. And now it has a trigger for reversion, and it's barely started. Like S&P 500 down 8% is nothing. Bloomberg Economics is expecting to go down to about 4,000. Right now, the S&P 500 is 5,400. And that's in case of a U.S. recession.
I got to bring up gold miners because they've obviously lagged behind physical gold very badly. If gold breaks above that 3,500 or even touches 4,000 like you're talking about, do we see a major re-rating in mining equities?
The problem I've had with gold miners for 3 years now, Jeremy, every single metals conference I've gone to, that's been the top subject. Why are the miners and the equities not keeping up with the underlying gold? The key problem I've had with this is if the miners, like GDX, for example, does not keep up with gold in an environment when the stock market's making record highs, what's going to happen when beta starts hitting lower, which it's doing now? So yes, miners should continue higher with gold, but gold is still driving. And in fact, gold's driving the whole precious metals complex. So yes, gold's a little expensive versus bonds, which is, I think, is going to be the next big trade. I've been wrong on that one for a while, admitted, but haven't really lost, we haven't really lost money in T-bonds. Is once we see that inflection of the U.S. stock market actually breaking down versus most trend lines, it hasn't done it yet, then that flips the narrative towards treasuries and away from gold. But the bottom line is that we've had a decent bull market. It's just getting a little stretched. And how far is it going to go? Don't really know. Can't play in between. But the number one thing I'm going to be publishing on tomorrow is it's all about the U.S. stock market. If it stabilizes, everything's good. If it continues down, those bond yields are going to just do what they always have done in history. It's just making it as difficult as possible.
Yeah. And to your point, Mike, I mean, there's still a strong U.S. tech bid. Retail isn't really capitulating here. If the correction is short-lived, could we just be resetting before another leg higher? I mean, long term, yeah.
We could. That's not my base case. I think it's unlikely. I think we finally got the reasons to do a correction. And the bottom line for me is, and this is a matter of time we get the bigger one. This is the key thing that I started, some of us started writing about this 2 years ago. I started calling for $50 crude oil when it first went above 100. It's the way cycles work. The prices goes up too much, it makes it go down. Same thing in the stock market, just much greater lag. The key point about it is if you're buying U.S. equities here now, you're buying them just after they reach the highest apex versus the rest of the world and U.S. GDP in almost a century. So sure, we might get little bounces, but I think the whole world's starting to get this is just a risk asset that got too expensive. The road to reversion is difficult, but it's the more you delay it, the worse it gets. And I think we've delayed it because some of us expected it to start in 2023. It didn't. And what really happened is massive fiscal stimulus. Now, some of that's supposed to be being shut down, but we know the Fed's out of the picture. We can't get the monetary anymore. And prices are just so high, they've reached a higher plateau. How long can we stay there? We know that's not too long. Now, you can't do that in commodities too long. It's stock market. It's just more of a lag, and I think it's heading downwards. Again, for me, it's Bloomberg Intelligence is bottom line for the S&P 500 is around 4,000 in the case of a U.S. recession, and our tilt is towards a U.S. recession.
Okay. Yeah. I mean, many people calling for it. Before I let you go, I got to get one final big picture question in. I mean, you've compared today's market structure to 1929, 1989, the peak of U.S. exceptionalism. If we're really on the other side of that peak, what does that mean for investors in the next, say, 6 to 12 months in terms of positioning here? I mean, you've been talking about it here What are we looking for? Any other signs?
Yes, the signs I'm looking for is it'd be nice if we can see one of the key leading indicators has been the Bloomberg Galaxy Crypto Index. Now it's already rolling over 100-week, 200-week moving average. S&P 500 hasn't yet. So you're looking for signs like that. Maybe it can show early strength. The U.S. stock market showing resilient strength, that would be great. But I think the thing is the data usually lags. But the problem is when you get to 2 times GDP, the stock market becomes the economy. Like I said, we've backed up $6 trillion so far this year. That's the wealth effect. That's what, 10% of the economy of GDP. It's just maybe it's different this time, but that's my point is this is almost inevitable that it won't be different this time. I think the trigger is this year for it to revert. It's starting to, and so far we've seen nothing yet.
Yeah. All right. Mike McGlone, senior commodity strategist at Bloomberg Intelligence, breaking down one of the most critical macro shifts we've seen here in years. As you can tell, I mean, gold rising, risk assets unwinding, and traditional safe havens are flashing red. Thanks for this, my friend. Have a great week.